Good evening to all of you. Welcome you to today's webinar. Today we are going to look at the investment in mutual funds, but along with that we will also look at the parameters, that is the some financial parameters on which we had discussion on Tuesday. Because I think those are also very important to know, that when we are buying stocks, how risky it is, what is the safety margin that is available with us, and where we should book profit, and so that we don't need to go with the already run stocks. That is, if the stocks are already run very significantly, we should be very careful. So while touching this, we thought probably we should talk about one particular mutual fund which is closely aligned with the fundamental investment. That is, one is the balanced mutual fund, balanced advantage funds. So there are many funds. We are not going into any specific ranking of firms, because there are so many parameters on which they are ranked. So what is the main objective of this? See, generally when we look at our own investment, what we tend to forget is that a good stock, after it comes down to decent levels is after a significant correction, we should not panic, we should be a buyer. Similarly, when it has run very significantly, we should book the profits. And after we book the profit, suppose if we don't get alternate investments properly, then we should shift our funds basically to debt funds or FDs for some time. And then again, when the particular stock or the broad market corrects, then we should do the investment. So that is the most judicious one. Because we don't understand a lot of things, and because we can't involve ourselves in the full time, we need to entrust our money management or fund management to somebody else, which is let us say one class of asset managers is the mutual fund. In that, when we hand over, we get a lot of options. What is it that we can do with our funds? Now, we have already seen many times that there are different types of funds, even in equity asset classes. Then you got in debt asset, then you got in gold ETFs and all. So we have seen funds like this before, that is the ETFs, which is predominantly index ETF. This is one. Then we have large cap funds, large plus mid cap funds, all there. Then you got multi-cap. Then you got flexi-cap. Then we have exclusive mid-market segment caps. Then as small cap funds. Then we have got funds which are sectoral funds. Like we have got the IT funds, digital funds or IT funds they call. Then banking funds. Then we have got pharma, infrastructure. So there are so many then government PSU funds. So there are so many funds which are also sectoral funds. Then besides that, we get what we call as the value funds. Okay, value funds. Then we have got hybrid funds, then balanced advantage. So there are so many funds which are there. So it all depends on our objective of investment in putting funds, and also our understanding of the market in putting it in different funds. Generally, in funds, the most risky funds will be sectoral funds, because if it goes up, it will give a very, very high return. If it goes down, it will pull you down very significantly, because they are not that diversified. They are concentrated in one sector. Now, if you look at IT funds, it has done phenomenally well in the last 3-5 years, but this year it might have underperformed. Banking sector funds, for a very long time it was underperformer. Now it has done well. So we do not know when these type of funds perform well and when they do not perform that well. So sectoral funds are more risky. Since it is more risky, rewards are also possible. So unless we understand that particular sector and also get a good grip of when to invest, we should be a little careful about it. Now, index funds are generally much more safer, and large cap funds comes next, because large cap funds will almost mirror the index fund plus some profit plus additional yield you get depending on how the fund manager allocates its assets. Similarly comes multi-cap, which may also do inline or slightly better doing large cap during a bull market. Then probably we have got a flexi cap. Small and mid cap also, like sectoral funds, take a lot of risk, and so a beating is possible in a bear market. Then of course we have got hybrid fund, balance fund, value fund. And what is a hybrid fund and what is balance advantage fund? So there is some distinction. Now, so I told you what is the objective of our investment will decide which fund we are going into it. Now, if our objective is that see, when the market is less expensive, we should get into equities, and when it is more expensive, we should trim down. And when you trim down, that asset should be allocated into a debt market, and that particular debt, whatever invested in the debt market, should be trimmed and allocated more to equities when the market falls. So that is one objective. Second objective is probably compared to other funds, the risk should be lower. Okay, compared to other funds, the risk should be lower. And third thing is that the return also should more or less correspond to a return of either the index or large cap funds. So if these are the objectives, then in that case balanced advantage fund gives one particular solution for this objective. Now, the difference between hybrid fund and balanced fund. Hybrid funds has debt equities, but the debt will always have, the fund will always have some debt. Maybe it can have 30%, 40% depending on what the allocation the asset manager at one point of time has given is in his fund objective. That much of debt will always be there. That can be churned between maybe government securities, corporate bonds, some other debt instruments maybe, but there will always be debt. But in the case of balanced advantage fund, it can be like a pure equity fund or it can be like a pure debt fund. So that is the difference between hybrid fund and balanced advantage funds. So the fund manager like us will have to decide whether we should be into a pure equity now or whether we should be into a pure debt, or at one point or at any point of time we should have a mix of both the equity and debt, and what proportion. So that flexibility is there with the fund manager. So that is the biggest advantage of balanced fund. And because you got some component of debt always, some and good component of equity, the risk of this particular mutual fund will be much lower than the risk of a pure pure index fund or pure large cap or multi cap funds. So you will have a return which is almost commensurate with a big index fund or probably even with large cap funds, but the risk can be lowered. Now in this scheme, normally when we talk about other mutual funds which are a little more risky, where we are not able to take a proper call, SIP is normally advocated, because if you do SIP over a period of 3 years and 5 years, because 1 year SIP has one advantage and disadvantage. The disadvantage is that you do only in a year which is a bull market. Then when the market falls, then probably we will not be able to do that. But in the case of a 3 year and 5 year SIP, the overall thing, it gets averaged out, right? So you get a higher return when we do a 3 years SIP or 5 year SIP, that we can always see. So even if you do 10,000 rupees per month and you do it consistently for 3 years, the return of that total amount can be more than one lump sum amount at any point of time, because it is able to average, because there will always be some big fall which can come in the period of 3 years and 5 years. We have seen 2020. In 2022 there has been a correction of around 15-18% from the peak levels. So these things tend to happen. But in the case of a balanced advantage fund, we don't need to emphasize too much on SIP, mainly because the fund manager is in a position to do that because like an SIP is deciding that whether we should be more into equity or whether it should be less into equity. So because of it is dynamic asset allocation character, so that the basic thing is you have a very dynamic asset allocation. In the case of balanced fund, you got a very dynamic asset allocation. Because you get a very dynamic asset allocation, the SIP is of less importance. I'm not saying that SIP is going to give a lower return and all. I'm saying SIP is not that critical like the normal SIP which could be in other type of mutual funds. So to that extent, the dynamic asset allocation is very important. Now, when you're going for sectoral funds, I think SIP is very important because at any time, any particular sector can have a fall. We have seen in the case of banking sector, we have seen even in the case of IT sector. So you will at least average it out at all levels. So you don't need to worry about the valuation parameters. So now the valuation and other parameters which we are talking about for fundamental investing becomes very crucial when you make one lump sum investment. Now, let us say TCS. If you are deciding to invest in stock like TCS or in IT sector by itself, the basic thing that will keep on working in your mind is, see whether this has come to decent value for us to invest. Okay, from here, how much of growth I can get as far as the stock is concerned, what will be the return. Okay, so whether I should be in this sector or whether I should be in other sectors. Now, that portion of uncertainty or the doubt factor to a very large extent can be compressed or can be sorted out by going for a SIP scheme, because the SIP will take care of that particular doubt. Because should I invest now or should I invest later? Doing this confusion, you may not even invest. But what the SIP does is, you are investing now, you are investing at some stage later on also. So even in a bull phase of that particular stock, you are invested. In the bear phase also, you are invested. So what happens? It takes care of that particular thing. So you do it for a slightly longer period. Now suppose, let us say you are done only an SIP in the case of TCS only for the last 3 months. It may not be that workable. But if you do SIP over a period of say 1 year, 2 years or 3 years for consistently, let us say you buy TCS maybe for 5,000 rupees every month, and for 3 years you averaged out. Surely at one point of time your SIP investment in that particular stock definitely will give you a higher return. So it is almost a no-brainer, except we have to only decide whether this particular sector is a good sector and whether this business is a good business, and what has been the historical thing of this particular sector as well as the particular stock. Stock SIPs are always a little dangerous because you are not having a diversified thing, because if one stock gives way, whether it's SIP or lump sum investment, you will suffer. But whereas if you invest in a sector, the risk is less, because there are other stocks which can compensate for one stock fall. If you are investing in a broad-based fund, then in that case your risk becomes even lower. So as you approach, attack the risk portion of it, of course the reward portion can also be lower. But still, what is your objective? Now suppose, let us say you are looking at something like, I want, see FDs are giving a very poor return, which is around only 5-6%, and then post-tax I am getting much lower return. So what should I do? Then in that case, you are looking at something like, even if you get 10-11% with a much more efficient tax structure, you will definitely prefer that, isn't it? So the balanced fund to a very large extent can also be considered, not exactly as a substitute, I wouldn't like to use it, but can be considered as a substitute for FD. That is, because it carries lower risk, not that it doesn't have, it carries a lower risk for the return that you get, and that for a period of time there is a good chance that you will aim that getting something closer to 11% or so, closer to 11%, which is where the index also gives, right? So this 11% probably you can enhance it either through the SIP thing, and what you can do is that you can do also, after some time you can do a systematic withdrawal plan also. It's like we have been talking about systematic investment plan. You can also do a systematic withdrawal plan, which means that you invest, and after some time, let us say after 1 year, you say that every like an FD pays you interest. So here like this, every month you will withdraw some amount. Let us say, for an example, let us say you are investing 10 lakhs, right? So in a year, a 6% return will give you 60,000 rupees, right? Now what you say is that this 5,000 rupees per month, you go for a systematic withdrawal plan, and after 1 year. The reason why I'm talking about 1 year is for capital gains. Now you say today is July, so from next August you would like to take 5,000 rupees systematic. You can give that information later on also. You don't need to do it while the investment itself. Later on also you can give request for systematic withdrawal. Now if you do a systematic withdrawal of 5,000 rupees every month after 1 year, this 5,000 rupees, the 60,000 rupees, even if it is considered as a capital gain, it is less than 1 lakh in this scheme, right? So 1 lakh, up to 1 lakh, we are exempted from capital gains, right? So you can do the systematic withdrawal plan to match your like a FD, okay? Then after some time, the corpus will still grow, because even after a withdrawal, normally the markets run up, right? So markets run up to some extent. So what you will what you will get is that you will get a return from the remaining part of the fund. From the remaining part of the fund, you will still get a return, and that return, since you have already got 6%, maybe it will another work out to an overall thing of 10 to 11%. Even if you do a systematic withdrawal plan, you will get this. Okay, mostly you get over a period of time, whether it's 3 years, 5 years, or 10 years, you have a very good chance of getting this much of return, and you carry a lower risk. You then, by efficient capital gains payment through by staggering your systematic withdrawal plan, you are slightly avoiding you are reducing a capital gain liability also at the same time of withdrawal, and you are getting a post-tax return which is much better, of almost double the FD rate of the present FD yield. So the balanced advantage fund is generally a good fund for a conservative to slightly risk taking investor with a systematic withdrawal plan, possibly even with a systematic investment plan, and a very good idea to generate consistent, stable, higher returns and lower risk. Now one of the funds we will see, we are not trying to promote any fund, just for example we are taking that fund, and say let's say ICICI Prudential. Now ICICI Prudential Balance Fund. Now this is the 1 year. If you return, I am unable to. This is the background is white. We can't change the background, and I'll read it out for you. The scheme has given in the last 1 year 7.46%, as against Nifty's 4.62% return, as against 4.62% of Nifty. Now if you look at the 2 years pattern, this scheme has given 16.28 versus Nifty's 14.35. Now 5 years, this scheme almost matches Nifty, 9.5, 9.7, but 10% over a period of 5 years approximately, and I'm sure that will grow. And when you say over a period of time, that is longer period of time, Nifty, that is we're talking about 2007, 2008 period. From there, Nifty has given us 10% return. Nifty has given 9.5% return. And this scheme also has given 11%, 10.88 or 11% scheme. So it is generally beats the index by around 1.5% or so over a period of time, and for the lower risk. So that means it can be accepted. Okay. So the longer term return you get 10.88% for a lower risk, which could complement your investment in other funds, because it's not that every fund you will take the risk, right? So suppose you are taking already putting money in multi-cap, because the multi-cap will contain both large cap and mid-cap and small cap, flexi cap, something very similar to that. Then of course you may have put money in sectoral funds. So let us say you're allocating 5 lakhs, 5 lakhs, 5 lakhs, 5 lakhs. One of the allocation should be in this. It's a good thing, and probably substitutes what we can probably do for a slightly conservative FD type of investor. So there are many funds in this. There are so many 40-50 funds are available. You can look at the funds in maybe there are other sites which can give you a lot of information, value research online, moneycontrol.com. So you can go and make further research in this particular scheme, and then probably consult your advisor also, wealth advisor, for more information and probably for a investment in this fund. How you are going to structure that, all those things, I think it will depend on your resource allocation and your risk appetite and what you need at what point of time, right? So this is the balance fund which we wanted to touch, and right now we will look into some other financial parameters, as well as also to the present trend which is happening right now. So we will now first go into the financial parameters which we were discussing on Tuesday. So we talked about the PE, we talked about EPS, okay, how these are important. Now there are other important ratios as well, like profit to book value, return on equity, then enterprise value to EBITDA. So EBITDA, then you got enterprise value to sales, price to sales. So there are so many ratios which probably are all looked at to know what is the fair value of a particular, what is the fair value or should be of a stock. Okay. So there are different ways where they look at it, and based on the past experiences, the general identification that if the share price, if the market comes to say this particular sort of PE or this sort of ratio of profit to book value, then in those cases the investment can be done. But normally when you work out all these things, when we say about all these things like PE, EPS, all these ratios you should always look at it within the sector first of all, because the PE of a high growth stock can be different from a PE of a mature industry like steel industry. So today maybe you'll see a very low PE trading for Tata Steel, but a very high PE for TCS, a very high price to book value for TCS, a very low price to book value for Tata Steel. Okay, so it's not possible to compare across sectors. Maybe we have to take so many other factors also in order to look at it, because one particular ratio alone we should not use for comparing one stock of one sector with another stock of another sector. It can be done within that particular sector to know whether certain stocks are undervalued or overvalued depending on some of these parameters. So that is the first point that we should know, that the PE and EPS of one sector of within that particular sector, then what is the PE, EPS, all those things of that, and why the market gives only that valuation for certain. Now for example, if you look at the IT sector itself, in IT sector itself you have got so many stocks like let us say TCS, this gets the highest, then you got Enfi almost matching this, then you got HCL Tech Mahindra, like that. There are so many other stocks also, Wipro. Okay, similarly we go to the bank, we got private banks itself, HDFC Bank, then you got ICICI, then you got Axis Bank, then you got IndusInd Bank. Now then other banks are there. Now these two banks get a much higher valuation in terms of all parameters than Axis and IndusInd Bank, right? So in this, if you compare, what is the PE, what is this thing, and then try to understand whether some certain things are undervalued or overvalued, then probably the investor or the fund manager may allocate more to this and less to this. That's possible. Okay. Or if it is already run in valuation, this has not run in valuation for some reasons, still that may get some attention. So within that particular sector, we should know that why this particular stock gets a higher PE, why this stock gets a lower PE. Okay, one. And so whether this has become more investable or this becomes lesser investment. At the same time, we should also know that what is the whether within the by standard by HDFC alone, if you want to invest HDFC Bank, then in that case, what has been the general no ratios on which it takes support. Now, suppose if you say the PE of 18 or 19, broad market, for example, let us say Nifty itself. Now, Nifty PE a couple of days or this month at one point of time it came to 18. Now, if I look at the long-term average of Nifty, it is around 23, 24. Most of the bullish periods it will be 23, 24 or even more. And doing a slightly heavier fall, it comes down to 20. Okay, even getting much below 18, it's not happening. Though the long-term average still now is going up, up, up. So what is the longer period of the average we have to see between 2011 and last 10 years? If you take, I think mostly you should take the 10-year average one. So if the fall is coming closer to the 10-year average, it itself is a very good place where you can go for investment. Now Nifty, when it came slightly below 20, I was calculating and telling you last on Tuesday that why you should go, why you can go long in Nifty at any dip or any dip, because of the likely expansion of PE from 20 to 24 during a bull move and even more, plus also the earnings growth. Both put together will give you a very good return in case if you are investing between 18 to 20 PE. 18 to 20 PE, very good chance that there is a huge amount of safety net available for you to grow at something like 11-12% per annum or even 14-15% per annum over a period of time. You are sure to get when you get in 18 to 20 PE. This time it has offered the thing because we should prepare ourselves, because the moment it comes to those levels, there are so many people who are buying, so many funds which are buying. We will not get much of a time to trigger that. So we should be in a position to do that immediately whenever the fall takes place. So right now, let us say, coming back to the same point, that is the PE of HDFC Bank, ICICI, PE of Axis Bank and this one, and this PE itself, whether this is expensive or not. This is one parameter. PE is one parameter. Then we look at the price to book value. We got a price to book value. Then you got a, let us say, we'll look at all this thing: dividend yield and earnings yield. So price to book value is the present price. Now let us say Reliance. Let us say it is 2,400. This is the price. Okay. What is the book value? Now the book value is nothing but generally, they do it as, I'm not going into too much of terminologies. Total assets minus liabilities, which is almost the equivalent to the free reserves. So it's the reserves plus the common equity. So the reserves plus equity will constitute that, and so the price to book value. Okay. Now if you see Reliance, generally speaking, it will come, the book price to book value right now is around 2.1, let us say. And during the last 5 years or 2000, even 2015 to present value, the lowest it touched was 1.6, let us say, price to book value. Now the book value of Reliance is something like 1,140 or so, approximately. I'm not able to remember exactly, but it's around that. So when you're talking about this into 2.1 or so, it comes to 2.3 or so, whatever it is. Okay. Now, if it comes to 1.6, that has been the fairly the lowest point. So we cannot expect that to be the lowest point to always touch. Only in some bearish phase it will touch, then it becomes a good place for investment. So this 1.6 place, that is the lowest when it comes. Okay. Now 1.6 into 114, that comes to 1825. So you will come to know that based on price to book value, the lowest that probably based on the valuation parameters, unless it is a degrowth company. Okay, so the book value of Reliance will continue to climb. Okay, based on their profit growth. Now, based on their past. So when you talk about 1825, okay, based on the price to book value, this could be the lowest. Now, lowest is not something which is going to be achieved at any point, because it's the lowest means when you say 1 or 2 times only in the last 5-6 years it would have touched. So we should not go with this. We should go with something something like 20%, 30% away from this. Yeah. So now, if you're getting another, say, 2.1, if it comes slightly down, maybe to 2 or 1.9, that itself will become, so a 10% fall, probably, maximum, which means 2.4 dropping down to 2.2 or 2.1. Okay, so we should not aim for this. It becomes a good place for investment for Reliance. So this is, now along with that you look at the technical parameters. Now there are so many other bases where people may be talking of a lower this. I am talking only from price to book value. But if we talk about based on the PE, still it is trading at a very high PE, maybe 25, 26 PE. Generally, it used to trade below 20 PE, which means another 20% fall, which could be another 500 points, which is still 1825, 1890 levels. So to some extent, the price to earnings and price to book value can come a little closer, around 1850 to 1900. But if you are looking at other valuation parameters, which could be enterprise value to EBITDA, enterprise value to sales, those things which you're talking, probably it could be even lower. We don't know. I'm not saying that, but it could be lower. But not necessarily. So you will have various parameters which will keep on flashing that this is the level, this is the level, this is the level. So do not attempt at the fair value. It will not, only during a very extremely bearish phase, stocks generally come to the fair value. But mostly it will be slightly above the fair value even in this phase. Okay. So to what extent it is above the fair value is what we need to calculate. So we have to take all the past history of the last 10 years, probably work out that to what extent the average level of the price to book value is, and let us say average price to book value. You can just Google it and see for Reliance. Average price to book value for last 5 years, let us say. Now you got say value research online. Go that and see what is the average price to book value. Whether we are getting that, we will see. So the last 10 years, the price to book value, the median value is only 1.75. That is, average values now is 2.08. The median level the last 10 years is 1.75. So let's look at the last 5 years. The median value itself is only 2.19. So we are below the average. We are below the average as per the last 5 years. The last 3 years also it is 2.19 is the median. We are 2.08. So look at the last 1 year. The median is 2.22 and we are below that. So last 10 years is 1.75 and 2.08. So which means very clearly that we are okay as far as the price to book value is concerned. We are below the last 3 years, 5 years median, and we are very closer to the 10 years. Not very far off. Maybe another probably 10% fall, which is what we are saying about a 2.2. Now the price to earnings also, the median has been the last 10 years has been 15.6. We are at 25. So that means the market has assessed it as a growth stock, because if it has been a value stock or stock which is not having any big expansion plans, we would not have got such a high P. This one, that is the present P of 25.04, when the median has been only 15.6 in the last 10 years. So let's look at the last 5 years to get a more realistic sense. The last 5 years median is only 23.37, and we are at 25. So the P the last 5 years, no, with all the reportings that has come, with all the problems that we have faced from 2017 to 2022, the valuation has come to 23.37. Right now it's 25. It is 23.3. So there maybe a 5. It's just a 5% away from the 5 or 25, 23.37. If we get to that 25, we are at some 7% away. That's what we are talking about. Even in the case of price to book value, we are talking about possibility of a 10% fall could bring it to a value which is equivalent to a 10-year median value of price to book value. So any fall in Reliance, probably by another 6-7%, I think it becomes a very important investable. So 2000, the present price, let me see where it is right now. So it is at a 2457, right? So 2457 into 0.93. 2003 and 2285. So because 7% down, now we're getting the PE of that particular level, and 7% down right now in the price to book value of 2.98 makes it 1.93, which is a long term thing, very closer to that. So I think even 2.3. So we don't expect much below 2.1. So right now we can put it around between 2.1 and 2.3 to be the very good area for investment in Reliance based on all these parameters. Right? So we saw a dip coming close. That is why we are saying so many times when Reliance comes to 2.3. Let's go back to the chart now. So now we are looking at the technicals. So we are trying to merge the see 2.3 2350, 2360. We are not even getting 2.3 very below 2.3 any significantly. And last ever since March, after the March result itself, last result, the stock has all been generally trading above the 2350, 2360 levels. So which is a very good indication that probably much below this market is not expecting, and the median PE of the last 5 years itself is only 23.5 compared to the present level of 25, which means it looks from the PE ratio it has corrected enough, and probably another 5 to 7% fall to get a median PE of that particular level is possible. So and also a 5% fall will take it to very close to the price to book value of the last 10 years. So good place for investment. But how much it will grow will depend on the profit growth, will depend on the EPS growth over a period of time. So probably from this particular level, if Reliance is to grow the profit is to grow at 10%, 12% from here, we can expect the safety net is there. And if there is a further price expansion, PE expansion, which can take place in a bull market, then along with that of this particular, they say if we invested at 23.5, it goes back to 25 or so, we get a 10% in the PE expansion itself, plus the profit that we get in the PE, which comes from the addition to the EPS, which we get from every quarter to quarter or year to year. So now for time being, we have analyzed one particular stock from price to book value, and we have shown the importance of why the 2300 is very important as far as Reliance is concerned, and the worst could be 2100. I think from the fundamental point of view, where it definitely will get a good amount of investment attraction. So we will look at other ratios also in coming days, like dividend yield. We look at earnings yield. Then we will also look at how the return on equity also should be considered, and we look at example to example in some important stocks for these parameters, and look at where those particular stocks stand at that point of time, and what is the safety that is available for us. Okay, so now we will look into the present Nifty rally and Bank Nifty rally. So this is right now. So let's look at a big chart, weekly chart first. Now this has crossed this particular high, right? So this high has been crossed. So since this high has been crossed right now, I think the next low should be very important. That is, I think no, we should look at either this particular level, which is the 16,425 or 16,275. So 16,275, I think we can keep the stop loss right now, but that's also a little quite high. So what we should look at it, even this particular high is going to be, a low has been going to be crossed. That is 16,824 has been crossed, and this is also 16,800. So from the weekly chart, no, we need to look at 16,000, probably 16,410. I think this is this low, which we got 438. I think this low is going to be the week low. So keep 16,430 as a stop loss now. So right now, Nifty bull trend continues. 16,450 stop loss. Now where it will go, the 200-day moving average is coming closer to approximately 17,200. And also that's also important Fibonacci ratio for the big picture. Let's look at the so the big picture is 17,270 or 280. So 17,270, 280 is going to be a very important level. So closer to that we may head towards in this leg, if probably we don't get any further fall. And there is a chance of some pullback that can always come because it has run quite heavily. And so if at all the pullback comes, probably we can see some 400 points fall, which is what happens these days. So 16,500, 450 could be the important place. Now look at the daily chart. So this particular top to top. So this got touched today, right? So this got touched at 16,945, 947, and this is a very important line. And this 16,947, this could increase by another 35 to 40 points tomorrow. So we expect that even 16,975, 980. So there can be some pullback. So there can be some pullback right now, and we should expect that the pullback to first. So we'll draw the same line now. Put it here to the next. So the pullback should ideally should stop somewhere around 16,760 or 770. This is the level. So 16,752. 16,752. Any pullback, we should see that it is stopped at 16,752 levels. And even we can put this here slightly. This is so today's low is 16,746. So maybe in 16,770, 780. I think it should stop. 16,770, 780 can be an important place where it can hold. Only below that, I think we can get into a slightly bigger correction, and this gap should be closed for us to completely reverse. That is 16,650. So the first big stop loss is going to come if it's going to fall below this day's close, which is 16,720. So we can keep close below 16,720. Close below 16,720 is required for us to say that whether today's stop is a top or tomorrow's stop is a top. Then for a pullback, which could take it up to 16,475, 485 levels or so. Because there's always a 400 points fall, 400, 450, 400 points these days. So 16,950 it has already gone. 16,550 or 560 itself can hold. So this is the structure of the thing. A possible move at some stage to 17,200, 250 is a possibility. Now look at the bank Nifty now. Bank Nifty, terrific run. So it's also touched this line, right? So this is again probably a correction can, because whenever it goes to this particular line, there is always a pullback, and this is a very steep line. So definitely there should be some pullback on any rally tomorrow in Bank Nifty, and the first support can come. So this place above today's low, 37,090 or so can be the first important support tomorrow. It has gone to 378. So any pullback above today's low, that is 37,028. So 37,165 or so. So 37,165 or 170 can hold. And if you can put a stop loss below today's low, so you can buy closer to 37,165 or 170 and put in a stop loss below 37,025 for an intraday in case if it comes tomorrow, and 37,414, so closer to the 37,550 560 you can book your profit. Suppose if it starts with 37,550 or 560, be careful, don't immediately go for a buy. Wait for a pullback before you take a call on buying there. So Bank Nifty now in a bigger chart also, let us say weekly chart. Now it has closed above this particular. Now it is trading above this particular high. So we should be we should hold to this particular high. I think no, the 36,080 or today's this week's low, which is 36,248. I think that should hold 36,242, because if you see the trend generally in the last 5-6 weeks, not a single week low has been cut. So if tomorrow this low is not cut, then probably it's going to become a very important low, because whenever it starts falling also, if you see if it cuts one particular week low, then in that case for a couple of weeks it goes like this, then again it needs another week's low to be cut like that. So I think probably going by the same trend, we should be expecting this particular low to hold. This is this week low, 36,245. So 36,245 should probably we should look as if that's going to be an important low for a tradable stop loss for next week also. Tomorrow it may not cut to 36,248 going by the present trend. So for next week also we should keep any buying dip, keeping 36,245 as a stop loss. So this is the discussion for the day. So if you have any questions now, please ask. Thank you. So thanks for your participation, and hope to see you again with a new topic or continuation of the present topic, to help you understand the fundamental and technical blend of individual stocks and index. Thank you very much. Good night.